The government could shut down again in just 28 days. Most investors shrug off government shutdowns. That's a dangerous mistake. In 2026, markets are not resilient. They are fragile by design. A shutdown right now doesn't just cause noise, it can damage the financial system. If your money is invested, you need to understand what's coming. The data blackout, VIX risk. The Fed claims to be data dependent. A shutdown kills the data. CPINFBL. No data means no visibility. Algorithms can't price uncertainty without inputs. When the data goes dark, volatility must rise. The market is not pricing a sudden blindness. The VIX is underestimating this risk. U.S. Treasuries are the backbone of global collateral, but confidence is cracking. Fitch already cut the U.S. to AA+. Moody's warns governance failure is credit negative. A downgrade during a shutdown is explosive. Repo haircuts jump instantly. Margins rise. Liquidity disappears. This isn't fear, it's math. When uncertainty spikes, dealers stop lending. We've seen it before. Repo stress, balance sheet pullbacks, credit contraction. But now there's a problem. No buffer, no safety net. If treasuries become politically risky collateral, short-term funding markets can seize up fast. Each week of shutdown cuts about 0.2% from GDP. In a strong economy, that's noise. In 2026, growth is already slowing. That drag could be the line between a slowdown, slackness, and a technical recession. The risk isn't the shutdown alone, it's the combination. Data goes dark. Collateral credibility is questioned. Liquidity is already thin. All at once, that's how political theater turns into market accidents. Based on the systemic risks outlined above, consider the following tactical adjustments. Increase cash reserves. With the Reverse Repo Facility, RRP, drained and liquidity thinning, having dry powder is essential. Cash provides a buffer against margin calls if repo haircuts increase. Hedge against volatility. Since the VIX may be underestimating the data blackout risk, look into long volatility positions or protective puts to insurance your portfolio against sudden price swings. De-risk highly leveraged positions. If liquidity freezes, the cost of borrowing rises instantly. Reduce exposure to assets funded by heavy leverage to avoid being caught in a forced liquidation. Monitor credit spreads. Watch the gap between corporate bonds and treasuries. If spreads widen rapidly, it is a signal that the collateral shock is moving from the government sector into the broader economy. Focus on quality. Shift toward fortress balance sheet companies that do not rely on short-term funding markets to maintain their daily operations. This is not the time to be passive. Audit your exposure. Watch volatility. Track liquidity, not headlines. Markets don't crash from one event. They crack when systems lose trust. Follow for real macro risk breakdowns. Share this with anyone who thinks shutdowns don't matter.